maybe this might be the last session. Right. Okay. So once again, I say very big welcome to every one of us. Please, I appreciate if you can drop a chat in the chat box so that I'm sure we are all here. So let me also type something. Hello, everyone. Okay. So you can type in the chat box or just click on thumb up so that I'm sure we are here together. So once again, it's a very big welcome to every one of us. In our previous session, we're able to create our input scenario, right? And also remember that I said you can add as much thing as you want to add, but always make sure you are sensitizing those key line items that are crucial to the model outputs. Okay, and we also got started with our cash flow, which you said this will be more like the main thing that you really want to see. All right, to make a lot of decision. So in our previous session, we were able to complete our cash flow available for debt service, right? So putting our other approach of cash flow. So where we have cash inflow, or you have the cash outflow, and it's kind of very easy to see what is happening, how the cash is moving in each of the period. Yes, though I said we have overdrafts, more like a short-term debt. Okay, but I really don't want us to go that deep into it in this session, right? So basically, we have more like overdraft. Some call it revolver. Some call it short-term debt facility, and you kind of build that into the model. So which means anytime there's a negative net cash in any of the period, it simply means the business definitely needs to get cash from somewhere. Even from what we can see here on the annual basis, the net cash inflow definitely is showing negative. So which means in year 2, the business needs to consider obtaining another debt. In year 3, they need to consider obtaining another debt. In year 4, they need to consider obtaining another debt. And this is where you now see the true color of what we call operational model with the infuse of debt funding. At times, you see something like leverage buyouts, right, where a company is trying to inject more debt to be able to take over a company or make synergy or something like that. So in those cases, you really need to go deep, deeper, right? And then the model start becoming a little bit complex, where because now you're not taking it straight into concept of project finance course, right? So every time the model needs to calculate when there's not enough cash, it basically means you need to go and obtain debt. So there's a way we kind of build it such a way that is automated. So whenever there's a negative cash, the model will automatically take that cash, right? Do some other, maybe if there are some other additional line item that needs to be added. So you kind of build in a macro that do the copy and paste, and that automatically feed into your debt schedule, right? Then the debt schedule will now start calculating on its own. So which means you can have multiple debt inside a typical operational kind of model to be able to check with different interest rates and things like that. And that's where the interesting parts of the model of the concept comes into play. But as I said, don't let's dive too deep into it. Uh, Once you can be able to recreate something like this from scratch without having to look through the model, trust me, you are level up, right? So basically, what I'm saying is everything we've done, if you can recreate this whole model, starting from your blank Excel, right? Create the business concepts, start putting all the inputs together, go ahead, do your calculations, build out your asset schedule, build out your funding, create your 3 financial statements, and everything is balanced and looking good, then trust me, you are level up. Trust me, trust me. Okay, so here, this is where we stop. Cash flow available for debt service. This is the last thing we did in our previous session. Now, one thing we now need to do is we need to, so this is cash flow available for debt service, okay? And then let's consider, so below it, let's consider our debt service. So let's consider our debt service. And our debt service will be made up of our what? Our principal repayments, okay, principal repayments, and then we're going to have our interest expense. So these two guys, we make up our what? We're going to make up our. You can't see my screen. Okay, maybe it's coming from your own end. I think you'll be able to see my screen. Okay, so I think it's coming from only you. Well, let me stop and reshare again. Stop and let me reshare again. All right, so here we have our debt repayment, our debt service, So basically, our what? Our principal repayments, then we have our interest expense. Now, at times, which is also part of what you build into the model is what we call debt capacity. So which means the first thing you need to do is you need to build in what we call debt capacity into the model to be able to say that, hey, you know what? Based on this, our projection, this is the amount of debt that we can actually take. Then you compare that to the debt that you want to raise currently. Okay, so as much as we are trying to do everything, and that's one of the reasons I said it is operational in nature, right? You tend to test different thing, what is not, and that's one of the reasons in our input we always make provision for an option to always override. Okay, in fact, at times you could have an option where you also have your monthly input scenario laid out in this same structure. So operational model, you just need to be very creative, think about business, think about the way management think, because that's the same thing. You want the model to be able to answer everyone's question, and they don't have to be calling you back, having you to rebuild the whole thing. So from onset, those are the things you try to incorporate into the model. Okay, so let me link my principal repayments. I'll link it to we already have it in our cash outflow. Enter, so I can put this in. I think let's have it in our absolute value. And in our interest, also link that to my interest expense. I'll put both of them in what's in absolute. Okay, so copy that and put that under the monthly period as well. Put that under our monthly period. Put that under our monthly period. So one other thing is we can do is can have our annual total here, which I feel that might make sense. So if I do sum of only my annual value, not the monthly one, have it by the side like this. Okay, so for our total debt service, put that below. The total debt service, just summation of both my principal, my interest expense. So do that. So even looking at the total, you can see that there's already a problem already, right? Because if you say let's calculate our debt, our debt, service coverage ratio, okay? So which we call our DSCR. Basically, what debt service coverage ratio is saying is how much cash do you have to be able to meet up this your financial obligations. That's what the debt service coverage ratio is saying, right? So the coverage is basically saying cash available. Then the debt service is the element of our debt. I think that's quite straightforward, right? So debt service coverage ratio basically saying the cash that you have, which means the true cash that's being generated from our core business operation before financing. You still remember our income statement structure, the way I explained it, right? The core business operation before getting to those ones that are driven by management decision, financing decision, which is also what we've calculated here. Our total inflow minus our core business operation, excluding financing related costs. Okay, so we're saying this cash, how much of it can we now use to do what to can we check to our debt? So this is always uh, in times. So basically, it's saying equal to my cash available for debt service divided by what? Divided by my debt service. Enter. It's always in a multiple. I think we created something like X. Okay, yes. Period where there's no depth, then we can now use something like if function or something. So uh if if statement, if my debt service is lesser than 0, right? You should make it sorry, if it is greater than 0, you should do the calculation. If not, just close the bracket at the end. I'll say if not, you should just make it blank. That will not, just make it blank. Okay. But most times it's always good. The true picture will be shown on the monthly basis, right? Not on they won't check it on the annual basis. So at times it also depends. So if the repayment is based on quarterly, okay, that means they will evaluate the debt service coverage ratio quarterly. If the repayment is based on semi-annual, that means they will evaluate the debt service coverage ratio on semi-annual basis. So it's always periodical. Okay. Because so many things can hide under the annual one. And you can see here, this is lesser than, but this is even negative because you don't have any cash. So which means we need to also now do like a restriction. Okay, so basically, as I said, what the typical operational model, right? So all this period where you have a negative cash, it basically means you have more like a cash to sweep from, which is typically your overdraft, or if equity would decide to bring in cash during this period. But as I said, the whole uh, objective is equity is fixed. There's no equity coming in. So you're just trying to see how you can leverage on borrowings to be able to do what to earn a lot of return from the business operation, right? So you can see the period where is, so now the way it also works is there's always, they will give you more like an expected minimum debt service coverage ratio, which you need to be able to measure against what you have. Okay, but before we dive too deep into that, let's now have our cash available for dividends, and that cash available for dividends will then be what? My cash flow available for debt service minus what? Minus my debt service. Minus my debt service. Minus my debt service. And see the cash that is available. Even there ought to be a restriction that if, because now basically what this is saying is we really cannot pay dividends as we've stated up here. So it's always more like a circle thing, a circular thing, right? Because this is the true cash that we have. So cash available for debt service for dividend payments. So if you look at it on the annual basis, we're saying I have a cash available which I've generated from my typical business operation. Then I need to pay these debts. Okay, so by the time you pay these debts, this is the cash that you now have available before you can now even think about paying your equity holder, because you need to settle your financial obligation first. Okay, so which means in this second year, if you look at the dividends we've calculated in our previous model, okay, we are saying in this year 3, the amount they are going to pay, whereas they are even in one big hole trying to fill up this cash. There's the second period, the same thing. They're already in big hole. So which means this year 3 year, 4, definitely there won't be any dividend to pay, right? So it now becomes a circle thing, because we need to feed this back into our dividends calculations and saying, hey, if there's no money available, if there's no money available for debt service, right? You know what should happen? Don't pay the dividend that we've calculated. I hope we understand that, because this now becomes more like a restriction. Okay, so cash flow available for that, for debt service, cash flow available for dividends. Now, as I said, at times we most times go the other way around. So there's always more like a minimum debt service required, and based on that, we use that to calculate our what? To calculate our debt. So there are so many things incorporated into it, but I'm just trying to minimize it so that we are not really not doing project finance. But the truth is, when you build this kind of operational model that business use daily, at least monthly basis, definitely those are the kind of things they really want to see. They want to get quick loan, overdraft, short-term borrowings. These are definitely more of the requirements that needs to be checked. Okay. So as I said, typically what we do is, you see here, we still now going to add another line item. So just like that line item is what we call, some call it overdraft, or some call it revolver financing, and at least maybe most people can relate to this. So they call it some call it working capital debt. Either of these three. So that means this cash, this negative cash that we have in each of this period, you know what will happen? So so as I said, most times we usually do something like a macro. Let me just do like an example for you to see. So equal to, I will say minimum of minus this cash available, or 0. And so before, no, so you should give me, okay, minimum of this, then you should put it back in positive, right? And if I drag this across, so that means this period where we have negative cash, right? What will now happen is we then we then believe that this funding, which is really huge, right? This funding gap, then we feed it back here, because we expect this to be what, to be funded by so okay, yeah, so it's part, I think it's correct, so it should come in as positive. Yeah, I'm starting from, yeah, so it will come in here as positive, right? And then flow straight. So you can see now that here now our net cash flow for those period, instead of it to be negative, you see what it becomes. It then becomes what? It becomes positive. Becomes positive under each of that period. So instead of having a negative cash, there will be nothing like negative cash, right? So I think recalculation, then this one is still giving another result. So which means this overdraft, this working capital debt that you are now bringing, we also comes with its own costs, come with its own interest rates, comes with its own repayments and due thing. That means you now need to feed it back again. Then it becomes something becomes circular, right, in nature. But as I said, don't let us go into that. I don't want to scatter the whole class. So let's still keep it where we are now. So basically, if you look at this, and we calculate our debt service coverage ratio. So we usually calculate minimum debt, minimum DSCR. Then times you have like average DSCR. And then you have your maximum DSCR. But most times the borrower usually prefer the minimum. So they also have their own expectation. They can tell you that, hey, you know what, it must give us this minimum something. So to calculate that, I use my mean function. As I said, you're not doing it under the annual, so you are doing it under the monthly basis, right? Okay, yeah. So basically means, see now, negative, negative, negative. Okay, which means that's the minimum, and it's not even up to positive. Then if I use if you look at the average, look at the average of it, 0.38. Then we look at the maximum one you are getting, then 0.89, which means so definitely they will tell you that there's no way this business can meet up the debt obligation that they want to get. Then management now need to start re-strategizing, replanning, and say that, hey, do you feel the financial projection is reasonable? Do you think we can do more? If you want to try and do more, what will be the cost? Right? Because any plan, any strategy you are trying to develop will definitely come with its own costs. Okay, so this is basically what the financial want to see, to be able to see, hey, what is your debt available for debt service, and how will you be able to meet up in each of the period? Okay, and the other way around is where we use the minimum given debt service coverage ratio to calculate our debt that the business can take. Okay, so please, if you have any questions, you can type in the chat box, please. I'll be reading them and also answer them. I know it's getting a little bit interesting. So basically what we are saying is, you know what we did here, where we are saying, hey, this will be our total debt for each period. Okay, what will now happen is, based on the minimum debt service coverage ratio they've given us, that will be what we determine the debt that we can actually get. Okay, so if you are saying, hey, you know what, we want to, our total use of the total amount we need to set up this business is 2.6, approximately 2.7 million. Okay, what will now happen is, we do all this calculation the normal way we've done it like this. By the time we are done, we now come in here. So let's say here, we'll be giving, they'll call it minimum debt service coverage ratio. Okay, and I guess that will always be something like, it will be like in input format. So input formats. So input formats, let's say most times always 1.5 or 1.25. So that also depends on how risky your industry is, right? So let's say this one is 1.5. Okay. Now we have our cash available for debt service. This will now be used to determine the debt that we can get, right? So you do this, then you now need to do your computation to be able to discount it back to the value that is worth today. And that will now determine the total debt. So for example, let me just do one. So here, let me say cash. So our CFAT, cash flow available for debt service, based uh, based on DSCR, or sorry, not CFAT. So this should be debt service based based on our DSCR. And what's basically what we are saying is, come under each of the months and type equal to this my cash flow available for debt service divided by what? Divided by my minimum debt service. I can drag that across. Okay. Then I need to put a restriction. So max of this was 0. So that whenever the cash flow available for debt service is negative, it's not going to calculate. So don't worry, I'm going to share the recording with us here. This is getting interesting. Okay. So now, which means if I sum this together, on my monthly basis, so basically saying based on what we have, this is the maximum debt that this business can take, right? But in reality, this is actually not true yet. And you know why? Because this forecasted cash flow, the level of certainty cannot be determined yet. So which means what we now need to do is, we are now going to discount the cash flow. It's as good as someone is promising you 10 million next 10 years. right? And you are trying to look at what's the value today. So which means we need to discount all the cash flow to a what today. And it is on it we now calculate the minimum, the we now calculate the debt service based on that DSCR given. And that will now be, which means this amount, after being discounted, is what will now become our what? The new debt. So which means what percent of it will we make from our total funding that we need? Then the company now needs to determine how they can fund get the other funding, either through equity or some other means of equity in funding the business. But as I said, I don't want it to look too complex. So for this cash flow, let me remove this minimum, right? And we just stop it here. Okay, okay, okay. And then and there's also something we call headroom, but basically your headroom is still your concept of your cash flow available for debt service. So if it's business that is already up in operations, right, then you calculate all your expected financial obligation and see how much headroom, how much cash do you think the business can still take in form of debt, right? And it won't stress the business operations. Okay. So please, any question, any question? And if you prefer, you want to open your mic, you can just click on your answer and I will give you permission to type in the chat box. Any question? Any question? Kind of getting interesting, right? But he said we are not going to project finance, so don't let us do too much. Let's stop it here so that you also take your time to go through it and understand the concept. Any question, addition, subtraction? Okay, so it looks like there's no question. So the next thing, which I promised us last week, is our investment evaluation. So let's do our investment evaluation. Let's do our investment evaluation. And also based on that, we should be able to do our discounted cash flow valuation. All right. All right. We good? We good? Any question? Okay, so now let's go straight into our investment analysis, which is also very crucial when it comes to you building typical operational model. What are the key metrics needed, right? So one, ratio is one. As I said, we're not going to be doing ratios together in this session. You can't always get to do that on your own. You have all the metrics, all the data needed to do your ratio calculation. So now let's go straight into our analysis. Now, before we can do our analysis, we need to be able to do something. Now, let me give us a brief explanation, because this is one important component when it comes to business and investments evaluation. We have let's assume I'm trying to look for a very good example for us to understand the next thing we need to do. Okay, so let's assume we have expected cash flow. Let's say we have expected cash flow. Okay, so let's say like 1,000. What's our unit? Okay. Let me just copy this. This is just example. You don't need to do this. Let's look at my screen first. So I have an expectation of what? Of 1,000 cash flow. If I sum it together, it's as good as if what I'm expecting. Let me make this 100. Okay, yeah. So 100,000 USD. So it's as good as, hey, over the next 5 years, I'm expecting 500,000 USD. Now, the whole concept of finance is all about how we manage risk and take advantage against inflationary effects and other components. Now, let's now look at what we call level of uncertainty. Uncertainty. Right? Please, I would like us to make this very, very interactive. Just use the chat box. Assuming I promise to give you 100,000 USD today. Is there any risk or any time value effects attached to it? What do you think will be the level of uncertainty of the purchasing power of that same money I want to give you today? Just type in the chat box. So just type percent. What do you think will be the level of certainty? Let's put it in percent. So maybe 100%, 1%, 5%, like that. So if I'm saying, hey, I'm giving you this 100,000 USD today, what's the level of certainty of the purchasing power of that cash that I'm giving to you? Simply, I will need our responses. I think we have almost 19 people. Okay. So definitely 100%, because what? I can take that same money, I can take it to the market today, and I'll be able to buy something that is worth that same thing. Now, okay, very good. Which means that 100, take it to the market, has the same purchasing power as what is worth today. If you now go to year 2, but I now promise that, hey, you know what? I won't give you that 100 USD today. I will give you in the next 2 years. What is the level of uncertainty? And let's use a good example of a country like Nigeria, right? Imagine if you've taken like 100,000 to the market, to the supermarket last year. Imagine what you can buy. I think when inflation was still around 19, 18%. And today, that same 100,000 is now being given to you. Where now inflation is what? Is almost around 30 something percent. Almost around 32, 35, 38. What's the level of the purchasing power? Okay, so Tolu is saying 70%. Yes, let me hear from others too. Based on the purchasing power of what that same 100K would have bought last year. Taking an example, a country like Nigeria. So someone is saying 70%. Okay, 40, I love that. Someone is also saying 50%. Yes. Someone is also saying 50%. Okay. So which one should we go? Let's see. Using 30% should be around 67%. Okay, I love that. Interesting. All right, so 60 to 65. The truth is we really don't know. But you know what? Let me put 65. Let me put 65. Let me put 65. So the truth is we really don't know. If we are doubting what the level of uncertainty will be in year 2, imagine what will happen in year 3. Right? The level of uncertainty then do what? Increase that. Hey, you know what? We don't know. So maybe the purchasing power will be around 40%. Right? So when I'm saying the level of uncertainty, let me just add the purchasing power to it. So by the time you are looking, you are watching the video again, you understand. So purchasing power. So which means the longer the period, the more the level of uncertainty. Then year 4, maybe we are now going with, you know what, 20%. Then year 20%, year 5, it drops down to 5%. So now it's kind of difficult for us to know, right? And you know, the whole concept of finance is to be able to remove human input. And we use something like a macroeconomic data to be able to make that decision. Now, what we are doing here with this level of certainty is what we call discounting factor. Discounting factor. Some call it WACC. Some call it rate of return. For some industry, it is called cost of equity. Is there any other name? Is there any other name for it? So call it discount factor, discount rates, weighted average cost of capital for a company that is using both debt and equity. Call it rate of return, which is more like fund investors' expected return. Then we also have what we call cost of equity for some business, for some industry that's equity based. For example, finance industry, banks, we use cost of equity for them most times. Okay. Now, which means for us to now be able to make a reasonable judgment as to the level of uncertainty, the purchasing power, we need to be able to calculate what we call our WACC, which is the next thing that we now need to do together. Okay? Okay? So I just want us to understand that concept so that by the time we are saying, now let's go and calculate our WACC, we will not be asking that, why are we calculating WACC? What is WACC? So simple term, that is what WACC is helping us to do, to determine that level of uncertainty using macro data. So let's get started. Let's get started and let's build it together. So weighted average cost of capital, WACC. WACC. So let's build out our WACC together. So please, as I said, if you have any question, please ask. Now, as a finance person, you need to understand that WACC really play crucial parts when we value a business, right? Really play a very, very crucial part when we build our business, when we do our valuation, investment evaluation. So in other words, it means I can access the viability of a business last month and the business is viable, and I can reaccess that same business using the same forecast value, and the business might not be viable in this month. In other words, it means it is time sensitive, just the same way market is. It is very, very time sensitive. And that's why a real investment evaluation will tell you it is at a point, it is at a given time. A normal valuation will tell you valuation as at specific date. Right? So which means you can evaluate a business today and tomorrow you evaluate it and it gives you different results. It's not that because the figures are changing, it's because the market data, they are changing. And I hope we all know the formula for our weighted average cost of capital. Anyone? I think that should be cost of equity, right? Cost of equity multiplied by what? The percent of equity contribution. I hope I'm correct, you guys. Then cost of debt, right? Then multiply by what? The percent of our debt. Hope that's it. Any addition, any subtraction? Am I correct? Please correct me. As I said, I'm also still learning. I'm also still learning, right? So now let's first calculate our cost of equity. So we are doing this together, please. And for our cost of equity, we usually start with what we call, so weighted average cost of capital is more like you have the format already, right? It's just for you to get your data, plug it, and calculate it. I think the debt should have tax considered. Okay. Now, as I said, the first thing always remember, let's put as at what? So as at what is today's date? So let's say we are doing it as at 28th September 2024. As I said, always keep that in mind. Always keep that in mind. Always keep that in mind. I think debt should have tax considered. Isn't there supposed to be a COD multiplied by 1 a tax rate? Okay. I'm sure by the time we do the calculation, you guys will see it. All right. So remember, as at 28th September 2024, that means it will be based on the data we are getting. Now, the second thing is calculating WACC, which I said is very, very crucial when you are building model. Is number one, it depends on the operation of the business and the cash flow. In calculating our WACC, it depends on two things. Where operation of the business, that is the location where the business is operating, where the business is generating most of its cash flow from. And secondly, the projected cash flow. And I'll give you a very good example. The business is operating in Nigeria. Now, because of the investors, they are external, which is mostly what we usually see. Then they decide to do the financial projection in USD. Okay. In that scenario, the business is generating its own cash in Nigeria, which is the local country, but is presenting the cash flow, the cash forecast in USD. So which means what we usually do is what? We are going to compute the WACC based on USD with the adjustments for the local country, right? To be able to get the WACC. Now, at times we now then do the conversion of the USD WACC into the local WACC. So, though we are not doing business valuation, so we are not going deep into that, right? Then the second one is where the business is operating locally and the forecast cash flow is also local based. Then that one you really don't need to stress yourself that much. Or if the business operation is generating cash flow from different countries, then definitely you need to build WACC for each of the region the business is operating in, and then you now need to weigh it. Now need to weigh to be able to get your actual WACC that you will use. But for this one, the business is operating in US, definitely is generating a cash in US, and the cash forecast is also in what? In US. So first thing we need to do, so that means we are going to use our normal local WACC. So we need to start with what we call synthetic risk-free rate. So sorry, I might not be able to give you guys some of the full explanation because this is not valuation class, right? But there's no way we do investment viability that we will not do compute our WACC. Now, synthetic risk. What is this thing? So which means first thing is we need, so under what we are doing now, we want to calculate the cost of equity. The cost of equity. That's what we want to do now. The cost of equity. The cost of equity. So please, one thing I also want you to do is, I know you know WACC. I know you've done WACC computation, but please, you see that knowledge that you know before, please put it one side. Have open mind, right? Don't look at this as don't be objective, either be subjective, right? If you are not clear, ask, let's discuss, right? Some things are done, we have some things in the textbook manner and so many people do it, but when it gets to the real practice, right? Yes, we still do it according to the textbook, but we factor in a lot of business reality and things the way it's being done normally, right? So as I said, yes, you know how to compute WACC, but please be open. Don't, as I said, I don't know it all as well, right? So don't be objective, try to be subjective, have contribution, let us know, right? Stay open, right? Learn the way it's being done properly. Okay, so many people can put, but I think that's where my mind also shifts while I was starting my career. When I did projects and my boss was asking me, where did you get this? And I said, oh, I went online. And so he was saying I did rubbish. I was like, no, I went online and this is what I saw being done. And it was like, are you for sure? And he said, you know what? I should create something and put it online. And I should just try to optimize my search, my search engine with Google and DOT. That if someone go there and search for the thing, that nonsense thing that I put is what it's going to be. So which means so many people really so try to learn the way things are being done properly. That's just the whole concept. So don't you go online now, too many materials, too many resources, everyone just trying to show you get. Okay, so synthetic risk-free rate. Now, what this is saying is you are starting a business, right? See yourself as my brother, okay? And I'm saying, oh, brother, I have these business concepts, but I need this so amount of money. What would be the first question you are going to ask me? So I'm saying, hey, you are my brother, right? And I said, hey, brother, my brother, I have this business concept and I need this amount of money. What do you think will be your first question that you are going to ask me? Let's type in the chat box. I said, let's make this very, very interactive. What will be your first question? So you have money, you are my brother. I'm sure you have that money. Then I, I come with you and I'm saying, you know what, please, I have these business concepts and I want you to give me this money. What will be your first question? He said, always think like a business owner. Yeah, let's type in the chat box. What will be your first question that you're going to ask me? What's my own benefit? I love that. Profitability. How will you repay me? Have you done your viability study? I love that. So basically it means, what is my benefit? What is my benefit? So which means the whole concept of business is all about benefits, 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 return, return. What do I gain? Okay. Now, because I'm coming to meet you and I'm saying, oh, you know what, please give me. So let's talk in dollar terms, right? So I'm saying, I've done the viability. I'm showing you the financial projection that, you know what, year one, this cash I'm going to generate, year two, year three. Now you will now sit down and be like, wait. So if I give you this 100,000 USD and you've projected this cash, now the cash has higher level of uncertainty, right? Because it's just in the paper. It's not as if I've started. That's higher risk of either I'm unable to achieve it or I can even achieve more, right? So two things. So there's no that even might not. Let's leave the even part. So is either I might be able to generate the cash can be lesser, which become riskier, or it is higher, which becomes a benefit, right? Then something click into your brain that, wait, the risk, this business is very risky because the level of uncertainty of the cash is just too high. And then you just went online. So while you were just thinking about it, you just saw a message from your government and say, oh, you know what, give us come and buy this bond, right, over the next 5 years. Give us, come and pay this, bring this 100 USD, and we're going to give you this return over the next 5 years. And you know that buying something from government, at least no way government will pay you. You have that higher level of uncertainty that they promise you 10%. You are sure that at the end of year 5, you are getting that 10%. Now, let me now ask you, which would you prefer to go for? Which would you prefer to go for? So now the government is saying, hey, 10%. Your brother that I want to give the money is saying, at least, brother, I'm going to give you 25%. Which would you go for? Free risk, right? Because it's government. There's really, the risk is very, very minimal. I can give this to my brother and tomorrow he decides to do what? And not do anything. And now, but because you are also a risk taker, you're saying, hey, 10%, but 25%. If you're able to commit so many things, okay, you know what? Yes, even though you are promising me 25% now, can I request for more? Right? Risk appetite. So which means the start point for us to be able to even discuss the return, to discuss what would be my own benefits, let's start with a risk-free, what I would have gotten if I'm investing in a risk-free what? Investment. That becomes the start point. And now, if we go to, so let's go to online. Let's go online. Let's go online because we are at a point today. So I'll go online. You know what I will do? I will now type US risk-free Okay, we call it risk-free, or at times we call it government, sorry, US bond, 5 years. So let's call it 5 years. So let's over 5 years. For 5 years, treasury yield rate. Yeah. So please do the same to search for it, and let me see what you have. So 5 years government bond, same thing as treasury. 5 years, what do we have? What do we have? What do we have? So for 5 years, that's so come here. So this coming from Bloomberg. So for 5 years, so which means this is giving us 3.51. So as I said, timing is very, very important. Timing is very, very important. So now this percent is as yesterday, 27/9, 2024, because of time variation as well. So 3.51, and that will be our what? Our starting point. Put this as my input, put it as percent, so 3.51. Yeah, so please go ahead, do that input into your own. So if you work in a company where you have a very reliable source, right? Please always use that. We don't usually use all these Google search kind of outputs. If you are working in a company that has a reliable data sources, right? So it's always good you use that. But Bloomberg is still fine. So 3.51. Okay. So if you also look at some other, let's look at some other sources, market to watch. Okay, to watch what they're saying. As I said, if you have your company has, it's always better you go with your company, because most of them are kind of paid version. Okay, yes, so 3.53. So you can even see the variation, even it's moving with time. So that's why I've said it's always based at a given point, at a given time. So now this is our what? This is our starting point. So which means anything I'm going to ask should always be in addition to assuming I'm putting my money in this kind of investment. Okay, that's the starting point. One, safeguard position. Then the next thing is I will now need to consider what is happening in that market. How volatile is the market? That is, if anything happen in the market generally, or something happen at the government level, how does the industry which this business will be operating in, right? How is it going to respond? How has it been responding? That is, for example, now there are some industry, if a government change, it will definitely affect that industry. But during the government's transition, that industry is always more like take a pause. You see that people will decide not to invest and be sure that okay, the next government comes in, then that's when they now try to know what to do. There are some industries, irrespective of anything that happen, that industry will still sell. Can you give me a good example of that kind of industry, irrespective of anything that happen? Even if they say inflation is increasing to 20 to 50%, that industry will still sell. Can you give me an example of those industry? Consumer goods, exactly, because they are necessity. Necessity. You have no option, right? For example, right? Rice, irrespective of anything that happen, people will still eat rice. People will still buy it, irrespective of the price. People will still buy it. So another example, banking industry, exactly. So banking industry also have that kind of, because definitely people will still bring money to the bank. Bank will still give loan. They'll still run it. But yeah, I think bank also even still depends on some other industry as well, right? And based on that, agriculture, right? Because they still need to produce, even though it's also risky because climate and all those things. So those are the kind of the risk that now comes with, hey, how will this industry do? And that's where we now have what we call our beta coefficients for us to measure the volatility. Okay, and we usually start with something. We start with unlevered beta. Unlevered beta. So unlevered beta is, we use that for business that has both equity and debt funding, right? Then we also need to now make adjustments for debt to equity ratio and consider marginal tax on it, right? So because we are saying the benefit of you using both equity and debt, right? Then you have advantage of uh, debt of tax. Okay, so now we need to get unlevered beta. Now in business valuation space, what we usually do is we kind of use two approaches. The first one is we look for comparable of businesses that are doing the same thing you are doing, but they are publicly listed, right? We get their unlevered beta. Then we remove those ones that are outliers and the odd thing. But if you don't have access to sources of information where you can get comparable of business that are doing the same thing, right? That's where we now have uh, our our valuation our valuation further, which we call Damodaran, right? So Ashrat Damodaran, right? So he has this website where you can get data as well for you to use. So let me drop this in the chat box so that you can click on it as well. Okay. So now, as I said, because of the timing, you also have the same thing. That's the way he has also structured the data. So you have your data here. So yeah, so if you go to his website, you will see, let me scroll back a little bit. So once you click on that link, click on the link, it will bring you to his website. Okay, and you can see data. So if you click on data, which is what you need, click on data, you will see that you have current data and you have the archive data. So as I said, it's always based on timing. So for example, now if we are, the way we are in September like this, if you want to value a business and the saying the valuation date is December 31st, 2024, you know what you do? All your data that you're going to use will also be backdated, assuming today is 31st December. That's just the concept, right? That's the concept of timing. So which means you need to go and look for those data. You look for the risk-free rate as at 31st December, not the one that is we are currently using. So that period timing is very, very important in WACC calculations. WACC cannot be constant monthly because market data also changes every month. Okay. So considering we are valuing it today, so which means we are using our current data. So click on the current data, and here we have the list of what we need. We have the list of different data that you can use, but for our own, we are going to be using levered and unlevered beta by industry, which is what we need. So here it's also our segmentation. We have the one for US markets, US market only. But for a business that, yes, is based in US, but they also supply to other countries, you have Europe, you have Japan, you have Australia, New Zealand, and Canada. Then you now have all emerging markets. So all emerging markets are I think it's more of Africa markets, right? And we also have some emerging market like that. So definitely you use those data. And if it's a business that you feel, okay, you know what, they kind of cut across the continent, then you can now use a global market. But for this our own, considering the business is operating in Nigeria, in US, do we think they will be able to sell outside to US? Yes, maybe. So I think let's use Europe for them. So those data are also different. That's why it's always very important for you to get it right. Right? You said the way things are done when it comes to proper way is different from the textbook or the way someone has taken a course and just drop it like that. No, there's always more than that when we get to the real business world. All right. So should we use US or should we use Europe? Let me hear your thoughts. Should we use only US or should we use Europe? Is US in Europe? Is Europe in US? Is US in Europe? That's the first question. What do you guys think? Is US in Europe? Our geography, guys. Do you know your geography? Do you know your map? Is US in Europe? I think that should be the first question. Is US in Europe? So as I said, see, and that's why you see, valuation analysts are most time people tends to hate them because of the way the kind of thing, the way they do things, right? So which means US is not in Europe. So why do you think we should use Europe? All right. So those questions, those things are very, very important when you're obtaining data. So maybe at your own leisure time, you feel, right? So I said valuation experts, definitely those are the things you need to know. We are not in valuation class. They ask you to download that US data, download the one for Europe. Now do comparison of those data, and you will see that very, very significant. Consider a business that is supposed to use all emerging markets for using US. Definitely the volatility in US will definitely be lower. The beta will be low as compared to the one in emerging markets. So let's use US. So I'll download US. It's going to ask me if I want to download. Then I'll download that. Let me go to my download and let me open the file. Let me open the file. Yes. So for the market beta, they usually release this, I think, twice, once in a year. So you just release it at the beginning of the year, so 2024, the next one 2024. So which means if I want to value a business as at 31st December 2023, I cannot use this data. I will need to go and download the one for year 2024. This is always very, very important. Okay. Now what we can do is you can move this worksheet. You can move this worksheet. You can move it into your own model. Okay, so that by the time maybe there's another new update, right, it's easy for you to go to the website, download the file, just do your copy and paste. Okay. All right, so let's move this. I hope you know, but before you move, so please, this is always very good. So I like the old data from, I think, column A to column P. Highlight it, copy, Control C, and right click and paste as value, so that you remove any other formula being linked to it. I know there are formulas inside it, so remove the formula first. So highlight from your column A to column P, Control C, then right click and paste as values, so that you know that there's no formula there. So that by the time you move it into your model, it's not showing what is not showing, then file link to another document link to another file. Then you can rename this to, I just rename this to beta. Name it to beta. Is it beta or beta? Either of the two, pick one. Then move it to our valuation. Then you can move it to the end. Move it to the end. Okay, so this is always good that you have the sources of your data in your model, so avoid different questioning here and there. And here we're now going to look for our industry. What is the business industry? What's our business industry? Manufacturing, right? Okay, so we then look through different industry that we have. I think we are doing cement, right? Cement, cement, cement. So let's check which industry are we going to put that fall into. So let's look at, so you have different industry at this. Your industry must fall under one of these. So for cement, I can see building materials. There we go. Chemical, coal and related energy. So please, once you see the one you feel this should be, let us know. Okay, building. Is it ordinary building or building materials? Okay, let's check. Just look. So most times it's always good you look through. Your own building. So now you see now we have building, you have building materials, you have own building, construction supplies. Very good. Your construction. Okay, yes, very. You see now. So this is most times this thing can also be very, very interesting when you are doing valuation. When someone is saying no, you can't put it under that industry. Another one is telling you no, you can put it under that industry. So it's always a very interesting thing when you are building your when you are doing your valuation thing, because anyone you pick definitely has significant effects on your work computation. So which one should we go with? Construction supplies. Let me hear from others. So someone said building, someone said construction supplies. Which one are we going with? Home building. Can use cement not only for home building, can use it for construction and for those things. Building mat. So we also have building materials. So which one should we go with? Which one should we go with? Which one should we go with? So building material. We also have construction supplies. Construction supplies. Then we also have home building. Okay, so someone say we should go with building materials. What do you guys think? Let me hear from you guys. I hope you also downloaded this. Let's assume I'm alone. I want to do this. Which one will I use? Hmm. Construction supplies, building. The reason why I'm doubting the building material is not only build. Okay, just use cement for different things, construction here and there. Okay, let me hear from one person. So I think we have three people saying we should go with building materials. Okay, someone said construction supply. Okay, now it's getting interesting. Which one should these guys think we should go with? Yomi said definitely construction material. The way he said that definitely. The way he said it definitely construction material. When you are building house too, you're also constructing. So road, you are using cements. You use it for so many things. Yeah, it is with a lot of infrastructure. So let's go with construction supplies. So let's go with construction supplies. Yeah. Sorry, my building material people. So let's go with construction supplies. Yeah, we building. Okay, analysis. So what you do is go to your work, the one we are building, type equal to, and link that to what? So under my construction material, right, which we are using, under my construction material, go under on level beta, on level beta, on level beta. That's the one you are using. On level beta, the one I'm having here is 0.95. So 0.95, 0.95. So 0.95. Okay. Then we have that. Then our debt to equity ratio as well. So debt to equity ratio equal to, so using the same debt to equity ratio of that industry. Construction, supply. So you also see their debt to equity ratio. Okay. So this is very important. Debt to equity ratio, put that. Then what is US rate? What is US rate? US corporate rate. Okay. Let me give us time to do that. So corporate rates. Anybody help us do the research and drop that for us? Okay, so for the rate, so 21%, right? And most times the reason why we call it marginal is, for example, oil and gas. Most time we don't use a corporate tax rate for them. We use kind of like a marginal tax rate. There's difference between um, applicable rate and marginal rate, right? So please always take note of that when you are also doing for some kind of business, right? So at times we also look at the business was what the tax rate they've been paying over the period. We look at it, but most times we usually prefer to use the corporate tax rate. But for industry, for certain industry, we use marginal. We use marginal. All right, so now let's calculate our beta coefficients. So let's calculate our beta coefficient. So which means we know the concept of a beta, right? So if it is closer to 1, it means the business is highly volatile. I hope I'm correct. Yes, I hope so. Or if the beta coefficient, if the unlevered beta is low, it means the business is what? That means the industry is kind of fine, does not, irrespective of anything that happen, it tends to not vary like that. And also these are where you also know if this is correct or not, because it's kind of show you how risky the industry is. Okay, so if you go to this beta, let me look for one. For example, now if you look at financial services, so this is how you also know how industry are performing. So financial services, those are non-banks, those fintech and all those things. So you can see 0.31. So it means irrespective of anything that happen in the market, it does not just move them anyhow. Food processing, you can also see 0.4 points. So all these ones are less than 0.5. So energy, renewable energy, which is the new word, right? 0.54. So just kind of tell you how the industry is performing. Right. So you can see banks, definitely banks, you can see 0.26. Irrespective of anything that happen, those guys will still make money. They still they still do the business and to move on. Okay. All right. So now let's calculate our beta coefficients. Beta coefficients, right? So we've seen this is how the industry works. So now because the industry is also making use of both debt and equity, they kind of have more like a tax benefit, which you now need to factor in. Now the formula can be somehow funny at times, but is equal to my unlevered beta, okay, multiplied by open my bracket 1 plus 1 plus. So now it's supposed to be 1 plus our debt to equity, okay. But because of the debt to equity, because the industry is making use of debt to equity, then they definitely have like a tax savings. We now need to do what? To factor in that tax into our debt to equity uh, ratio that we're going to use. Then that will now be my on better leverage multiplied by open my bracket 1 plus my what? Now I'm now going to do 1 plus open my bracket open another bracket, and that will now be my what? My debt to equity ratio multiplied by, open my bracket, 1 minus the tax rate. And I need to close my bracket 2 times. As I said, the formula can be funny at times, but just let me do it again. So basically what we are saying is my level beta, okay, multiply by, open my bracket, 1 plus, supposed to be my 1 plus debt to equity ratio. Okay, now, but because it's a mix of both equity and debt, which means the industry is definitely gaining marginal tax benefits. Okay, so I will now put equal to, open my bracket, another bracket, that will now be equal to what? My debt to equity ratio multiplied by, open my bracket, 1 minus my marginal tax rate, and I'll close the bracket, I think 3 times, and that will give me this. Okay, so all we're still doing is cost of equity. So we are doing is cost of equity. Then now let's now go to our equity premium. So please let me know in case you, okay, let me open the formula for us so that we can see it. I said my level beta multiplied by, supposed to be 1 plus my debt rate, because we need to factor in our marginal tax benefits. We need to remove that. All right, we good? Are we good? So what we've done is we've considered the starting point. If you decide to put this money into another thing, one. The second thing is we've also computed what is in the markets, what's happening in that industry. Now the next one is now what we call equity premium, which is now what I want in addition. Because I'm giving you that money, then you should be able to promise me something back in return, which will then need to be my own additional request. So we call that one equity premium. Equity premium. Now, for equity premium, each country has what we call equity premium. Each country has what we call equity premium. Okay? And that's why one of the reasons is always good you download the right data when you are downloading it. Now, for us to get our equity premium, we need a data that contain country and equity premium, which we need. Okay? Now, if you go back to our Damodaro website, you will see what we call risk premium for other markets. Right? So you see what we call risk premium for other markets. So this is the data that we need. Now, this one is always released twice a year. So they release one January and they release the second updated one in July. Right? I think because of the variation of what can happen in a different country. That's why they put this as release this twice in a year. So let's download the one for July 2024. July 2024. So I'll download the one for July 2024. Okay, go to my download. Okay, so go to July 2024, download it, open it, then you will see ERP by country. This is what we need. ERP, equity risk premium by country. So equity premium by country, right? Remember what we did the other time? Highlight from column P, and this one down to column L, copy and paste it as values so that we remove all the formulas, and I can now move this, I can rename it to ERP, and I'll copy, move a copy. So move or copy. Let me just create a copy into my own model, right? I can move it to the end, click on OK. Then I have my ERP. So now if you look closely, if you take a look at it, if you go to your country, the country where you are watching this from, for example, here in Nigeria, you can see our equity risk premium. See, total equity risk premium or country risk premium. So these are equity risk premium. That's for Nigeria. But our own one we are dealing with is what is US. So if I come here and I see United States, so you can see the equity risk premium. So this also let us know how risky it is to invest in some countries. Okay, let's see. Is there any funny one? So Lebanon 26. So you can extract and you can check all this to your home free time, right? But what we need the one for what? For US. So I come back to my WACC, the equity risk premium equal to, and I'll go to equity risk under US, and I'll select the one for total equity risk premium. So which means in addition to the starting point, I've decided to invest this in government bond, and this is what you are promising me. So that means you must give me this in addition. Right. So now we also considered what we call small stock premium. Small stock premium, SSP, and then we also consider what we call firm, we call it company, or some call it firm, company specific risk premium. So CSRP. Yes, so some call it firm specific risk premium or company specific risk premium. Okay. Now, all this small stock premium, company specific premium is just trying to, as equity, you're trying to find a way to manage your risk and be sure that even if the cash is not up to what it is, it can still give you a kind of return that will still be enough, right? So small stock premium are basically saying, if you want to invest in a public company, right? It's very easy. It's very easy for you. And even if you want to sell that stock, it is very easy for you to sell. So which means you have that assurance of, hey, I can get my money back anytime I want if I get this stock. But this is a business. It's just starting. So that means you need it to also be able to compensate for that risk. The second one is what we call company specific risk premium. Now, what this is saying is, oh yes, this is the cash flow you forecasted. Well, how sure am I that you can even achieve this forecast cash flow? That is what the company specific risk premium is saying. Now, for the firm's company specific risk premium is more of at times we use expert perception or the industry perception. So it's not as if there's like a readily made data for the company specific risk premium. It's just you're saying, hey, the uncertainty of the cash being forecasted, is it realistic? Is it not realistic? Right? What discount do you think we need to add, like an addition? But for small stock premium, there's a data for that. Let me see if something we can also get online. Let me. I think yeah, we should be able to get it online. So we call it size premium. Size premium. Okay, yeah. So let me just check these guys first. I'm coming. Size premium. There's it. They have the table. So it's like a table like this. Size premium. Size premium. Let me check the one. Can see. So equity size premium. So it's always like a table, not this. Let me see if we can see one. I know, I think PwC used to have or something. Okay, so let me check. I think it also used to publish one. So size premium, uh, Deloitte. Yes, let's check. Deloitte used have this. Okay, let me check this size premium. So it's like a table, right? As that's why I said if you are working in a company, there's this source, but I'm trying to see if I can get like an outside one. So size premium, I think PwC also used to publish their home. Okay, let me check this. Need the table. So it's like a table, right? Okay. I'm not sure why I'm not getting this publicly. What can we do? It's supposed to be available publicly now. It's premium. Okay, let me see. Size premium table. Should not be this hard. Check. Surprise is really not available. Something you can search. Okay. Let me see what I can do. Okay. So let me think maybe I should show you one. I have one here with me. I have one here. That one here. So let me show you what it looks like. Okay, yeah. So this is what it looks like. So it's more like the kind of rates where the valuation of your business, the range of your business valuation, right? And then the stock, the premium attached to the business based on your valuation, at least which your business fall into. So you have a low range, you have a high range, then it's based on DEXA from DEXA one base. If you're a public business that can be valued from 31 um, million USD down to, I think this should be trillion or something, then that means your business uh, premium definitely is zero, right? But most times, most startups usually fall below 0 million to 250 million dollars, right? So it's only if it's business that's now progressive and can now move like this. But most times for startup, we usually use this 4.8. 4.8. So it's like a table. sorry, I work where I have access to those data, so I didn't know it's actually not available to the public. Okay, so for this, let's just put 4.8. So 4.8, 4.8. Then for the company specific risk premium, as I said, most time this is kind of expert judgment. This kind of expert judgments based on the cash flow that you are seeing. But let's put it as 2%. Let's put this at 2%. Then we can now calculate our cost of equity. Let's calculate our cost of equity. So for our cost of equity is equal to our synthetic risk, okay, plus my beta, just plus the volatility. So in fact, let's do it like this. So equal to my synthetic risk-free rate plus, open my bracket, this is my beta coefficient, multiplied by what? By my equity risk premium. What is that? See that normal textbook formula, right? Then plus, I now need to add is my small stock plus my company specific risk premium to hit, and that will give us, what am I getting? So 15%. It is giving us 15%. Giving us 15%. 4.8. Let me show us the formula again. Risk-free rate plus beta multiplied by equity premium, which is the common one. Then we now add the plus the small stock premium and the company specific risk premium to it. All right, so please, any question, any clarification needed? Okay, so now let's do our cost of debt. Let's do our cost of, so we've done our cost of equity, and now let's do our cost of debt. So cost of debt. So for the cost of debt, we also start with the risk-free rates, the synthetic risk-free rate, which is always the starting point. Then you have your spread above risk. Then you now have your marginal, a marginal tax rate. Then we can now compute our post-tax cost of debt. The synthetic, which is the same thing we put up here. And for the spread above risk, just leave that as 0. Then marginal tax rates, link that straight to this. Okay, so for our cost of debt, we have our synthetic risk, spread above risk. Now for companies like for some emerging countries, right, we usually consider spread above risk. I think in Nigeria, if you go to I think FMDQ, you'll be able to see those kind of percents on it, the spread above risk, right? But for advanced country, the spread above risk, because their cost of debt is always not that high. So let's leave that as 0. But as I said, if you are doing this for emerging markets, emerging countries, then you need to consider your spread above risk, which is more like the additional, just like the way we have the equity premium addition to your synthetic risk rate, then the same thing also apply here. So for our post cost of debt, can't we use country risk premium for emerging markets? Let me say that, country risk. So the only way you can use country risk premium is when you are building. So if you are using a USD WACC approach, that's where we use country risk premium. Yes. So which means you are using, well, as I said, for example, a company is operating in Nigeria and the currency they presented is in USD. So what that means, so you have your synthetic risk, then you now add your country risk premium to it to give you your total risk premium. Yep. So that's where we use country risk premium. Okay, now for our post-tax. Our post-tax will then be equal to my synthetic risk. So I can open my brackets, my synthetic risk plus my spread above risk, then multiply by, open my brackets, 1 minus the marginal tax rates. Can you confirm the approach we are using? I stated this before when we started, that we have two approaches of building WACC, about 2 or 3 self that I explained. Okay, so which means the cost of debt we are getting, right? And I think if you check US current cost of debt, which they just slash down. Okay, right. So right, so at least for advanced country like this, usually have a low cost of debt. If you are building for one in Nigeria, that's where you'll be seeing double digits cost of debt. All right. So that's for the cost of debt. Then now we can now compute our capital, our capital structure. Now, as I said, most times where you have access to the data, you download the comparable and you use the comparable data. But most times, if you don't have access to those kind of information, you can always use that Damodaran data. So let's have our equity to capital, and then we have our debt to capital, Okay, formula for the cost of debt. So cost of debt is your synthetic risk, right? Plus spread above risk multiply by, which is you deduct your tax, which is what someone was saying when we started. So always make adjustments for the tax, both in cost of debt and also in your beta coefficient. So it's like saying my cost of debt multiply by, you deduct your debt from it, your tax. Okay. So for my equity to capital, now because since we have our debt to equity ratio, so that means we can get our debt to equity, debt to capital, right? And that will just be equal to my debt to equity, right? Divided by, open my bracket, 1 plus my debt to equity ratio. And that should give us our what? Our cost of debt. And to get our equity, just be equal to, that will be equal to 1 minus my debt to capital. and the summation of them should give us 100%. Right? Should I do that again? So said since we have our debt to equity ratio here, so we use the industry one. So come to your debt to equity and type equal to my debt to equity divided by my bracket 1 plus my debt to equity. Okay, close the bracket and press enter. Then my equity to capital will just be equal to 1 minus my debt to equity, and we have this. Now we can now calculate our what? Our WACC. Our WACC, and our WACC will then be what? Equal to, remember the initial formula, my cost of equity multiplied by my equity to capital, close the bracket, plus, open another bracket, my post cost of debt, okay, multiplied by my what? Multiplied by my debt to capital, close the bracket, and we have our WACC at 12 points. 12.57. 12.57. Okay, so let me zoom out for us to see. All right, so this is the proper way of calculating our weighted average cost of capital. And as I said, we are using a local WACC where the country is operating in the same country and is also generating the forecast cash flow is in that same country. Okay, can you explain the debt to equity? So debt to equity, since you have your debt to equity ratio, right? So this is telling you that hey, this is percent of debt to equity ratio. So for you to now use debt to equity ratio to get your debt to capital. So basically that is this debt to equity ratio, okay, divided by, open your bracket, 1 plus that same debt to equity, and that will give you your debt to capital. So since you have your debt to equity, just your debt to equity divided by, open your bracket, 1 plus the same debt to equity. So if you do equal to debt divided by equity here, it should give you the same, value of that debt to equity that you have. Okay. Since it took a lot of time creating this our work, and see is always important and very good. As I said, this is always at a particular given time. So which means if you are dealing with the data tomorrow, definitely you need to check if any of these data, if they've been updated, if they've been changed and something like that. So it's always at a given period of time. And now let's do our, I think we have less than 15 minutes. Okay. So let's calculate our free cash flow to the firm. Let's do our free cash flow to the firm. I think for our free cash flow to the firm, we can start with our operating profits. At times, I always prefer to see the full structure from revenue down to operating profit, but let's save time. So here, I'll just link this to my operating profits in my annual financial statements. Okay. Then I can have my tax. I can have my tax expense. What is our tax? I think we can just use the same 21% that we have here. Let me calculate my tax. So equal to max of, if the operating profit is positive, right? So equal to max of this, comma 0, then multiply by my tax rate, negative. I will argue about what? No parts. It's profit after tax. Add this together. Give us our no parts. Okay. We go ahead and we had our depreciation. Need our changes in networking capital. Then we need our capex. To reduce it, and that will give us our free cash flow to the firm, free CFF. Then I can go ahead and link them. So depreciation equal to, I can link that from my annual cash flow. Go to my cash flow. I just click on this. Then my changes, I'm just going to sum everything under my movements from inventory down to movement in Accra and other liabilities. My capex, also link that to my cash flow from investing. Then I can sum these together. One thing we forgot to do, right, which is always good you take note as a financial modeler. So typically, if you go to my cash flow from investing, you see that we only have capex in year one. The another period is dash. This is not a good practice. No business operates like this. So which means definitely you must always have capex provision for each year. So please always take note of that. I've seen great businesses being rejected because of something like this. So capex years in year one, then following, you must always have a capex every year. Take any company financials, at least public companies. You definitely see that on annual basis, there's always a cost going into their capex. So it's not as if the assets will just keep falling like that. So I think we made provision for that in our capex. Okay, yes. So you can see this maintainable incremental capex. So maybe you can say maybe starting from year 2, right, from month 13, maybe they'll be spending, can check, so factory building and all those things. So maybe they'll be spending almost 1 million on each. So I put this from the 100,000, right? Just more like maintainable capex. So much 25, I put that every year. Out of every year, they always commit that amount. And if you come to the annual financial figures now, you then see that at least this kind of makes sense, because there's like a recurring investment. Okay. So still everything is, this cash is still negative. And this is where your modeling work now starts. Right? Talk to the management, what do you think they can do, right? And stuff like that. But let's use this as an example. But it's always good. Maybe you should even make it, let's even say 20,000 USD. I think that's fair. So in each year there's at least an reinvestment in the business, and it's not see everything is just depreciating, and we're not making provision to even pay them back. Right? Consider that's what they'll be using, making their revenue. Okay, and also your free cash flow then now makes sense by the time we are looking at it. So I have a period, and this will be uh, previous period plus 1, that's period 1 to 5. Then we have our discounts. We have our discounts factor. Our discounts factor. That'll be our what? That's our WACC that we computed. Okay. You can now use this to do your equal to 1 plus my discount factor raised to minus my period. This gives us the discount rate. So if I put this in percent, then it gives us that same explanation of what we're doing then. You can have your present value, present value of our free cash flow. Okay, which will be equal to actual free cash flow multiplied by what? Multiplied by the discount rate. Copy that across. Then we can have our NPV, which is our net present value. So, under total, this together, basically this is telling us that the project is not viable. All right, but as I said, most times when NPV is negative, most times it does not always indicate the project is not viable. It means the business. So if the business is capital intense in start period, then they might require more than 5 years before they can do what's break even, which is break even in terms of cash, which is what NPV is telling us. So maybe most times we've seen a scenario here where we need to expand the model projection to 10 years to be able to see what will happen over 10 years, considering the each capex in the first period, which is really eating into the cash. And if we calculate our PV, if we calculate our IRR, so internal rate of return, IRR, right, being percent, then just use our Excel formula equal to IRR. I'll just highlight all my free cash flow to the firm, not the net present value. And this will also give us something like negative, right, which is also telling us this business is not viable over this particular period. All right, so here I'm going to drop my pen. Now, please, the work has not ended. This is where your own work is starting, right? As a modeler, definitely and it's your work, this is your company. You can't present a model to an investors and there's negative cash. Basically, you are saying there's no cash to run this business. So now, this is where modeling really starts from. You are done with phase one, where you have your model, everything is working perfectly. You have all your outputs, you have what you want. Now your work now starts with how you make this. Just need to make it to make sense. You now need to make this make sense, right? And as I said, you're also a financial advisor, you're a finance expert. That's why we call it a model. So this help them to know from start that you know what, hey, and as I said, and I always keep saying it, right? Evaluation is based on time bound. And I'm going to repeat this, right? Because I'm seeing someone saying comments, all this rigorous tax, the business is not viable. We must force it to be viable. Okay, I'll take that as a joke, right? So negative NPV does not mean the business is not viable. Yes, the concept of NPV is saying the business must be viable. And I repeat again, negative NPV does not mean a business is not viable. It means it is not viable within the time frame of our forecast. So please always take note of basic things, right? You number one, you don't first drive a model, it's what it gives you. But as finance experts, I just gave you one scenario of what we had to do in the case we faced something like this. One, business that has each capex in the initial period usually tends to have a negative NPV, and that's why project finance does not you can hardly see a project finance of 5 years. It's always from 10 years above because it's a long-term investment of a thing. So if you are committing this kind of money, which is kind of huge, right? You can't say you're setting up a business of billion and you think you will be able to cover up everything in 5 years. Nobody, no business owner thinks like that. So it means I said I've seen a scenario if the model will be used for investment, evaluation, and equity, what means is you definitely be forced to increase your projection to 10 years for a normal operational kind of model like this. Now, if within 10 years the business cannot still meet a positive NPV, then we can now conclude. But something like this, say, hey, you know what? Over the 5 years, consider that's the way we also put the analysis. By the time you are doing your model outputs analysis, that way you within this first 5 period, consider the huge capex which has eaten into the cash, right? We've decided to expand the model forecast to 10 years, and over the 10 years, the business can generate this NPV and also this internal rate of return. Okay. Then for the forecast, as I said, for the forecast, when you have something like this, most times it's always good you have a conversation with the clients, right? Run them throughout the model works. Let them also be able to look at what is happening in the model, what is giving rise to the negative cash, and what can also be done. You're also the financial expert. So you should be able to say, okay, you know what, think something like this should be able to make this work, this and this and this. And that is where what we call a financial modeler comes into play. It's not all about just putting figures in Excel, right? It's about that financial advisory part, because financial modeling is really a concept of corporate finance advisory thing, right? Because you cannot advise blindly. So you need that model available where you can play with assumptions, play with scenarios, and see how that works and that's how that can help businesses. Now, these are the things that are really lacking when you are dealing with a typical startup of businesses. They will just say revenue will jump like this, jump like that, jump like that, and they will neglect every other thing. But in real operational world, project finance, it is not like that. Right? You just cannot make it up. You can't make it up. Right. So I think I will drop my pen here for this our bootcamp session, and I will leave you to the rest of it. Okay. Okay. Just before I go, okay. Quick question: is small stock premium same as stock premium liquidity premium? I'm not sure they are the same. I'm not sure they are the same. So, as I said, no, they are not the same. No, no, no. So they are not the same. I think we have different premium. To say those premium can be confusing at times. So we have minority discount of a thing, right? Then we also have marketable lack of marketability discounts, which is I think that one is uh, family of liquidity thing, and then we also have a size premium and applied. So we have those different premium. Yeah. Right. So I will leave you to do the rest. Right. What are the other adjustments you think you can do to put this business to make a positive cash? Because see yourself as the representation of the company. You can't present a negative cash to their to them. Okay. So sit down with the model, try to rebuild it on your own, ask a question, be able to answer it yourself, make adjustments where necessary, make sure they are very, very realistic, and see how at least even if the NPV is showing negative, you can present a negative cash. And if there will be a need, okay, you know what, maybe in year two, they might need to bring in another cash, but we focus on working capital just to run the business negative cash. Then maybe equity can bring in another cash. So different option and all those things now be what you need to consider. These are the things we sit down with, right? I've worked on a model almost 3 months. And what was the whole discussion? How can the business become positive, positive net cash flow? Because business is showing negative, and all the assumption and everything are kind of realistic. So the seed and is there other sources of revenue they can generate? Do you think equity will bring in cash? Then the debt financial are saying, okay, if you are saying equity will bring out this cash, what is the assurance now that they need to state that and be that source and that cash is tied somewhere so that by the time they need. So it's all about it's very, very interesting when it comes to project finance. But don't let us do too much, and let me drop my pen here And hopefully, some other time we have another bootcamp session. If it will be advanced, then I will let you know. And if you are going to leave you guys that's already in the advanced level, that will be determined. So, thank you for now, and I hope you enjoy this session. So what I will do is I'm going to post this on my LinkedIn, and I would really appreciate if you can drop your comments, right? If you can drop it under the post, right? Right. So thank you, everyone. I've come to the end of the session, and as I said, the learning does not stop here. Keep learning, trying to rebuild. You know what? If you can build this on your own, trust me, anywhere modeling they are talking about modeling, I feel you can talk. But if you still cannot build it up to this level, then please just keep learning it, keep doing it, give it your best, give it your best shot. Right, right. So a lot of things we've covered here, not only about the artistical part of it, building. Right. You need to be the how management think about your business, how you put that in the figure, how you can also interpret, how you see it, forecast income statement, you can tell that too. Something is up here, this is that, and the rest. So don't let me overload you. I think we've done justice to this our bootcamp session. Right. So control, as I said, structuring, layout, and everything. You can see, be very professional. You don't need to put too much color. Simplicity and professionalism is what we do when you get to the corporate world, right? Proper structure, with the model, anyone can pick it and be able to also understand it. And also, by the time you come back to the model, you also remember, and it's easy for you to also understand. So, it out a monthly model, operational model, consolidated that into the annual one. And can we, as I said, please go ahead. Any other thing you want to do, you have all the data to do it, right? If you want to do your ratio analysis, add your ratio analysis. If you want to do your payback period, break even analysis, anything, add it. You already have all the data here. So once you have your three financial statements ready, every other thing they are picking the data from it. So add every other thing. If you want to build in your cash flow, and everything and all those things, build it into it, right? Is your board, is your core now, right? Play with it. Build, if you want to build a good dashboard into it, build it, and the rest is yours. Is the DCF sheet necessary? Yeah, as I said, if you're not adding valuation into it, you can remove it, right? To avoid story that touch. But once you've done the work, I think you can actually go ahead with your this year valuation. So the only difference from this NPV is just that you add terminal value to it, which is all. All right. So thank you, everyone. Thanks for your time. And this comes to the end of our bootcamp session program for this set. So thank you, everyone, and I hope you keep learning. All right. Please don't stop learning. Don't do garbage in, garbage out. Sit down, try to understand, take your time, rebuild it on your own. Right? You can rebuild multiple times. As I said, there's no way you can get better if you don't keep doing it. More than 200 model build. So if you are still on one, know that you have a long way to go with the learnings and the whole thing. So the more you build, the more you know, the more mistake you make, the better you get. So thank you, everyone, and please do enjoy the rest of your day. I will share the recording with every one of us. Yes. All right. So thank you, and bye for now.